Hello and welcome to Money Moves Daily, your China/Hong Kong briefing. It's Friday, September 5th. I'm Sophia Reyes.
And I'm Jason Miller. Sophia, it's a fascinating day for markets. We're seeing a generally positive tone across Asian equities, with both the Hang Seng and Shanghai Composite trading in positive territory today. But under the surface, there's a distinct note of caution, especially from some major players.
Exactly, Jason. While the immediate trading shows gains, the conversation behind the scenes is much more nuanced. We'll be diving into a stark warning from Nomura about the potential for a stock market bubble in mainland China and what that truly means for the real economy.
Plus, we've got the latest on China's cutthroat EV market and why some major players are still struggling to break even. We'll also hit some quick financial news from Hong Kong, including a leadership reshuffle at HSBC and the city's ongoing embrace of digital assets. And later, we'll tell you why China's upcoming foreign exchange reserves data is a must-watch. So, let's get into it.
All right, Jason, let's start with the elephant in the room. China's stock market. Despite today's positive trading, Nomura has issued a significant warning, suggesting that the recent rally in mainland equities could actually be a bubble with limited benefits to the real economy.
A bubble? But Sophia, the Hang Seng and Shanghai Composite are up today. We've seen mainland markets hit 10-year highs recently, which you'd think is a good sign, right? For the everyday investor, hearing bubble when the numbers are green feels like a huge disconnect. What exactly are they seeing that we're not?
It's about sustainability and the underlying fundamentals, Jason. Nomura's economists point to parallels with the 2014 to 2015 boom, which ended in a sharp crash and didn't significantly boost consumption or investment. They argue that aggressive monetary easing, while it might fuel market prices, isn't addressing the core structural issues. Things like the contracting property market and tighter IPO financing are still holding back genuine economic growth.
So essentially, we're seeing a market surge, but it's not really translating into strength for ordinary businesses or consumers. It's almost like the market is running on a different track than the actual economy. What does that mean for someone looking to invest in Chinese companies right now, particularly with mainland investors reportedly shifting towards Hong Kong stocks due to better valuations?
Precisely. It suggests that while there might be short-term gains, the risks are accumulating. Nomura is essentially cautioning policymakers against easing monetary policy too aggressively, as it could just inflate assets without fixing those deeper economic problems. The fact that Hong Kong stocks are about 20% cheaper than their mainland counterparts and attracting mainland capital speaks volumes about where investors see more tangible value right now.
Oh, no silver bullet, just a lot of hot air potentially. Okay, let's shift gears to something that feels like a constant battle royale, China's electric vehicle market. I keep hearing about new models and fierce competition. From an investor's perspective, are these companies just racing to the bottom with price cuts? Can anyone actually make consistent money in this environment?
It's a classic consolidation phase, but happening at an accelerated pace. Companies like NIO, XPeng, and Zeekr have reported smaller second-quarter losses, which sounds good on the surface. But those improvements are largely driven by deep discounts that lured more buyers. The challenge is that these companies still face an uphill task to meet their 2025 break-even targets. It's a war for market share, and profitability is often sacrificed for volume. Today, we even saw a BYD company among the top losers on the Hang Seng, down over 2.5%, which could reflect some of these competitive pressures.
So it's not just about selling cars, it's about survival in a brutal market. It sounds like only the most efficient and well-capitalized players will make it through this shakeout. Is there any light at the end of the tunnel, or should investors be extremely wary of the entire sector for now?
Investors should be selective. The market is huge and innovation is rapid, but the intense price competition is relentless. We're seeing some companies expand globally, like Chinese off-road EV brand 212, eyeing Europe, the Middle East, and Africa for growth. That's a strategy to diversify revenue and escape some of the domestic pressure, but it comes with its own set of challenges. It's a dynamic sector, but one where caution and deep due diligence are paramount.
All right, let's move to our quick hits, keeping the energy high. First up, in Hong Kong's banking sector, HSBC has announced a major leadership reshuffle.
That's right, Jason. HSBC has named Maggie Eng as the new CEO of its Hong Kong unit, a significant move within one of the city's largest financial institutions. This comes as the property market slump in Hong Kong has impacted loan books.
Next, an interesting development in the digital asset space, showing Hong Kong's push to become a crypto hub.
Indeed, Hong Kong crypto exchange OSL has officially started trading Binance-backed BNB tokens. This is happening as Hong Kong gears up to issue its first stablecoin licenses in early 2026, following the stablecoin ordinance taking effect on August 1st. A clear sign of the city cementing its position as a leading digital asset hub.
And shifting to mainland China's resources, some good news on the energy front.
Yes, China has announced the discovery of 2 major new shale gas fields. This is a boost for the country's energy security efforts and could have long-term implications for its energy mix.
And finally, some positive news from the Hong Kong Stock Exchange itself.
Absolutely, Jason. The Hong Kong Exchange, or HKEX, has reported stellar interim results for the first half of 2025, achieving a historic high in revenue of HKD 14.1 billion, up 33% year-on-year, and a net profit of 8.5 billion HKD, a 39% increase. It's a strong indicator of the city's financial infrastructure resilience.
That's a solid performance. Now, for our What to Watch segment. Sophia, what's on your radar for the next 24 to 48 hours?
My eyes will be on China's August foreign exchange reserves data, which is expected to be released on Sunday, September 7th.
Foreign exchange reserves. Why is that such a critical piece of data for our listeners? What does it tell us about China's economic health and its global standing?
It's crucial because it gives us a snapshot of China's external liquidity and financial stability. A healthy level of reserves indicates the country's ability to manage its currency, service external debts, and absorb economic shocks. It's a key indicator of economic stability, especially given ongoing global uncertainties.
Very insightful, Sophia. So we're looking for stability, but also clues about the ongoing economic narrative.
Precisely.
And that wraps up another episode of Money Moves Daily, China, Hong Kong. Sophia, always a pleasure breaking down these complex markets with you.
Likewise, Jason. It's been a busy day, and the next few days promise to be just as dynamic.
We covered Nomura's bubble warning, the intense EV price wars, and HKEX strong performance. For more in-depth analysis and timely updates, make sure to subscribe to Money Moves Daily wherever you get your podcasts. Leave us a review and let us know what you want us to cover.
Until next time, keep making smart money moves.